Warren Buffett is a legendary investor. He follows a value investing philosophy, which means buying undervalued companies. He believes in holding investments for the long term. Buffett focuses on companies with strong fundamentals. These include consistent earnings and strong management. Buffett's strategy emphasizes patience and discipline. He waits for the right opportunities and avoids emotional decisions. His approach has consistently generated wealth over decades and through various market cycles. Buffett's philosophy translates well to ETF investing. ETFs offer a diversified way to access his favored sectors. This essay will guide you through building a Buffett-inspired portfolio using international ETFs while excluding Australian stocks. This approach offers diversification, minimizes risk, and taps into global growth opportunities. Let's explore how to build your own Buffett in a box using ETFs. Avoiding Australian stocks might seem counterintuitive, especially for Australian investors. However, diversification is key. Overexposure to one market, even your home market, can increase risk. The Australian stock market is heavily concentrated, with financials and materials making up a significant portion. This concentration can limit growth potential and increase vulnerability to specific sector downturns. Looking beyond Australia opens a world of opportunities. International markets offer exposure to different sectors, including technology, healthcare, and consumer discretionary. Many of these sectors have higher growth potential than the Australian market. Investing internationally provides a hedge against currency fluctuations. When the Australian dollar falls, international investments increase in value. This diversification can smooth out returns over the long term. Exchange-traded funds, or ETFs, provide a simple way to access international markets. They are baskets of stocks that track a specific index or sector. Broad international ETFs offer exposure to a wide range of companies across the globe. One popular option is the Vanguard Total World Stock ETF, or VT. This ETF tracks the FTSE Global All Cap Index. It includes large, mid, and small cap companies from developed and emerging markets. Another solid choice is the iShares MSCI AQUI ETF, or ACWI. This ETF tracks the MSCI AQUI Index, providing exposure to companies in 23 developed and 24 emerging markets. These ETFs offer instant diversification, spreading your investment across thousands of companies. This reduces the impact of any single stock on your portfolio. It's like owning a small slice of the global economy. By investing in these ETFs, you gain exposure to companies outside Australia. You benefit from their growth potential and reduce your dependence on the Australian economy. The US stock market is the largest and most influential globally. It boasts a history of strong returns and is home to many innovative companies. Including US stocks in your portfolio is crucial for growth. Two popular US market ETFs are the Vanguard S&P 500 ETF, or VOO, and the SPDR S&P 500 ETF Trust, or SPY. Both track the S&P 500 index, which comprises 500 large-cap US companies. These companies represent diverse sectors, including technology, healthcare, and consumer discretionary. Investing in these ETFs provides exposure to the driving forces of the US economy. While these ETFs focus on large-cap companies, consider mid- and small-cap US ETFs for further diversification. These companies often offer higher growth potential and provide exposure to innovative up-and-coming businesses. Section 5. Delving into Buffett's preferred sectors with ETFs. Warren Buffett favors certain sectors for their long-term growth potential. These include financials, consumer staples, and healthcare. Sector-specific ETFs allow you to target these industries globally. Financial sector ETFs invest in banks, insurance companies, and asset managers. Consumer staples ETFs focus on essential goods and services. Healthcare sector ETFs invest in pharmaceutical companies and healthcare providers. Investing in sector-specific ETFs allows you to tailor your portfolio to your investment goals. Section 6. Embracing emerging markets for exponential growth. Emerging markets represent developing countries experiencing rapid economic growth. These markets offer higher potential returns. This comes with higher risk compared to developed markets. Adding emerging market ETFs to your portfolio can boost growth. Emerging market consumers are gaining purchasing power. This drives demand for goods and services. This creates investment opportunities. The Vanguard FTSE Emerging Markets ETF, ticker symbol VWO, is a popular choice. It tracks the FTSE Emerging Markets All-Cap China A Inclusion Index. This index offers broad exposure to companies in emerging markets. Another option is the iShares MSCI Emerging Markets ETF, ticker symbol EEM. This ETF tracks the MSCI Emerging Markets Index. It provides exposure to large and mid-cap companies in 24 emerging market countries. Investing in emerging markets requires careful consideration. These markets can be volatile. They are sensitive to political and economic instability. However, the long-term growth potential makes them an attractive addition to a diversified portfolio. Section 7. Constructing your own Buffett-inspired ETF portfolio. Building a diversified portfolio requires careful allocation across different asset classes. Here's a sample portfolio based on Warren Buffett's investment philosophy. Note: this is just an example, not financial advice. Consult a financial advisor for personalized guidance. Broad international ETFs, excluding Australia Vanguard Total World Stock ETF, Vermont, 40%. iShares MSCI ACWI ETF, ACWI, 40%. US market ETFs, Vanguard S&P 500 ETF, VO 10%. Spider S&P 500 ETF Trust, SPY 10%. Emerging markets ETFs, Vanguard FTSE Emerging Markets ETF, VBO 5%, iShares MSCI Emerging Markets ETF, EM 5%. This portfolio provides a good balance between growth and stability. It offers exposure to a wide range of companies and sectors globally. This aligns with Buffett's investment philosophy. Remember to adjust this portfolio based on your risk tolerance, investment goals, and time horizon. Regularly rebalance your portfolio to maintain your desired asset allocation. Section 8. The allure of low-cost ETFs, maximizing returns. When choosing ETFs, pay close attention to expense ratios. An expense ratio is the annual fee charged by the ETF provider. It is expressed as a percentage of your investment. Lower expense ratios mean more of your money is working for you. Over time, even small differences in expense ratios can significantly impact your returns. Fortunately, many ETF providers offer low-cost options. This makes it easier for investors to build diversified portfolios without sacrificing returns to high fees. When comparing ETFs, don't solely focus on expense ratios. Consider other factors like trading volume, tracking error, and the underlying index methodology. A well-rounded approach ensures you select ETFs that meet your specific investment needs. Section 9. The power of compounding reinvesting dividends. Many ETFs pay dividends. These are a portion of the underlying company's profits distributed to shareholders. Reinvesting dividends is a powerful tool for long-term growth. When you reinvest dividends, you buy more shares of the ETF. This creates a snowball effect. Your dividends buy more shares. These shares generate more dividends. This accelerates your wealth building. Reinvesting dividends also helps to smooth out market volatility. When the market is down, your reinvested dividends buy more shares at lower prices. This lowers your average cost per share. When the market recovers, you benefit from a larger shareholding. Most brokerage accounts offer automatic dividend reinvestment plans, or DRIPs. This makes it easy to compound your returns without lifting a finger. Section 10. The long game patience in the investment journey. Investing like Warren Buffett requires patience and a long-term perspective. Building wealth through ETFs is a marathon, not a sprint. It's about staying the course. Don't panic when the market experiences short-term fluctuations. Stay focused on your long-term goals. Remember that time is your greatest ally in the investment world. Review your portfolio periodically to ensure it still aligns with your investment goals and risk tolerance. Make adjustments as needed, but avoid emotional reactions to market swings. By embracing a disciplined, long-term approach, you can harness the power of compounding and build a solid financial future. Remember, investing is a journey, not a destination. Enjoy the ride.